Hello, I'm Ali, and in this lesson, we'll talk about client approaches to measuring performance. As per ASA 315, for every audit engagement, the auditor must gain an understanding of their client. And part of the process used when gaining an understanding of a client involves learning how a client measures its own performance. The key performance indicators or KPIs used by a client to monitor and assess its own performance and the performance of its senior staff provide an auditor with insights into accounts that their client focuses on when compiling its financial report, and which accounts are potentially at risk of material misstatement. Some KPIs are very common to many clients, such as return on assets and return on shareholder funds. Other KPIs may vary from industry to industry and client to client. It is very important for an auditor to understand which KPIs a client is most concerned about in that year so that the audit can be planned around relevant accounts. It is inappropriate to assume that all clients will use the same KPIs. It is also inappropriate to assume that a client will use the same KPIs every year. Just as businesses change their focus, KPIs change as well to help businesses achieve new goals. Generally, companies use profitability measures to assess their performance and that of their senior staff. Companies normally track their revenue and expenses over time and assess any variability. Companies compare their revenue and expenses with close competitors and assess their ability to compete, as well as provide valuable insights to management as to whether results are matching the expectations based on known factors such as seasonality or economic downturns. This also provides the auditor with valuable insights into the expectations of management. Normally, a company tracks revenues from month to month to identify and explain trends. Large companies compare revenues earned across divisions to highlight good and poor performance. Comparison between divisions may be used to assess how well the managers of those divisions are controlling costs. Changes from one year to the next year may reflect on increased cost of doing business or highlight that it may be time to source cheaper suppliers. Companies are concerned about their shareholders, and the price-earning ratio, which is market price per share, earning per share, shows how much a shareholder is willing to pay for dollars of earning. For example, a price-earning ratio of 15 means that potential investors are willing to pay 15 times current earning for a company's share. This gives value to the future earning capacity of the company. The next is earning per share, which is total profit divided by weighted average ordinary shares issued. This reflects the earnings return on each issued share. When a client's PE ratio or EPS are in decline, the auditor may be concerned that management may be under pressure to manipulate the earnings. Next is inventory turnover, which is equal to cost of goods sold divided by average inventory. Retailers and manufacturers are generally concerned about this ratio. An assessment of this ratio is made within the context of the industry in which a company operates. For example, a company that sells perishable goods such as milk requires a much higher turnover than a company that sells non-perishable goods such as furniture. If a client's inventory turnover falls sharply, an auditor may be concerned that its stock is overvalued. Liquidity is the ability of a company to meet its needs for cash in the short and long term. It is vital for a company to have access to cash to pay its debts when they fall due. If a company cannot meet its obligations, then it may go into liquidation. companies require cash to pay their employees' wages, utility bills, supplier bills, interest payments on money lent, dividends to shareholders, and so on. In the longer term, companies need to cash to repay long-term debts and undertake capital investment. Companies enter into debt covenants with lenders when taking on significant loans. That is the promise to maintain specified profitability, liquidity, or other financial ratios, or to seek the lender's permission before taking on new borrowings or acquiring other companies. These covenants are written into the borrowing contracts and restrict a company's activities. If a company breaches a debt covenant, it will need to renegotiate or repay the loan. So basically, these types of conditions put pressure on client to misstate accounts included in ratio, especially if the client is having difficulties in meeting the conditions written in the covenant. By understanding how their client measures and assesses its own performance and any restrictions employed by debt covenants, the auditor will gain a deeper understanding of the accounts potentially at risk of material misstatement. And in the next lesson, we'll talk about analytical procedures. Thank you.